Wake up, motherfucker.
What's up? What's up? What's up? It is April 13th, 2026. Okay, so what we got here? We got here, like I told you guys yesterday, you buy the software, got in at the open, I guess. Everything was up in the software sectors. Semiconductors didn't do anything outside of SanDisk, and I don't know what the rest of the market did. I don't really care. So I'm only focused on what makes money. So that's it. If you guys bought Palantir, Cloudflare, Cloud, whatever, anything with cloud in its name, hell, just buy it. Okay, the question now, though, is that are we going to keep going up, though? That's the question. Okay, so Oracle would have been one of them. Could have got Oracle. It was up 12%. You could have got, I guess, this thing here. There's 2x leverage, 25%. ORCX. So yeah, I'm gonna keep adding more and more names into what we have to do here to synthesize a IGV ETF that does leverage. Okay, L or AIBU. It's not exactly like IGV, but it's safer than IGV. As you can see, IGV can go down very quickly, right? The next time we got another Strait of Hormuz thing, I don't know. I can't guarantee you guys that this thing won't just crash right here. Okay? That would be bad. So you already see the problem here already. We got Strait of Hormuz, taco, right? On Tuesday, and then Wednesday it opened here and went straight down. That's bad. Anytime you see something like this, okay, after some kind of big event, that means the next several days it'll keep going down, at least. That's basic technical analysis right there. Anything that fades this strongly like that after a major event like earnings or anything in the news, that's it. The next several days it goes down. Luckily, we broke it today, okay? Even with the failed talks from JD Vance, it still recovered because I don't think there's anybody left to sell down here. It's very hard. We already had a big volume during the last time we went below this blue line. So we have to see how it handles trying to get back above here. Once we get through this range, it can go a lot higher. You have to remember, everything here fell since November, October, November, December. A lot of these stocks have already been crashing. This thing is down like, what, 30%? So it's ripe to bounce. Doesn't mean I believe anything about these stocks. Just means that it's good to trade, because once you have something oversold like this, it has to get up to some level before going back down. So if this thing wants to continue going down, it's highly unlikely it'll just drop from here to go down. So that's why I'm going to continue talking in this stream about waves and stuff. So you need to know some astrology, okay? You guys need to know human nature. Nothing goes down in a straight line. Nothing goes up in a straight line, technically, okay? That's why trading is hard for most people. They just want something that goes up in a straight line very easily, right? That's why they love crypto so much. Crypto just shoots up and crashes like nothing else because there's no liquidity there. Of course it does it like that. And it's full of people that manipulate. So they go up and down in straight lines. But here, as you can see, things don't go up and down in straight lines. They retrace, they go back up, they retrace, they go sideways, goes up, goes down, goes up, goes down, up, down. Very difficult. Okay, that's why most of the people that want to go short last week in software, really dumb, because everybody's trying to do that at the same time, and it's very easy for it to just to reflexively bounce because there's nobody left to sell. Everybody's hedging already. Okay, so that's the problem with most people. When they see everything going up like here back in October, November, they probably thought like it'll keep going up. Wrong. That's when you start going down. So that's the time you should short. Here we have the time to go long. All right, that's it. And they have a high correlation to Bitcoin too. So the same people that look at crypto seem to also be in software, all right, for AI. And I don't know. I guess they're not in semiconductors and they're not in oil, which is weird because like semiconductors is a straight line. Look at it. Very, very good. Close to a straight line. I mean, if you ignore this sideways move here and this drop here after earnings in November, most of it is a straight move up. So pretty perfect. Could you predict that? No, I don't think so. I mean, the last time we had something that good was probably after COVID, kinda. And then after the 2022 bottom here, kinda. This one is more had a nastier looking top here. See? You went up and down, up, and then you had the yen carry trade crash, pushed it out, went sideways for nearly half a year before crashing into April. After that, everything got reset and then we can move forward and go up. You see, most people can't figure that out. Most people will just buy and hold. They're not going to predict any of this stuff. So that's why the cycles come in. That's why I teach you guys the cycles. And then I teach you guys like looking at charts. Like if you see something like this going sideways, that's not good. That's why I don't like anything going sideways. Okay. Um, you don't know where it's going to resolve. Is it going to continue up eventually, or it will just crash, and then I could just get it cheaper, and then I get it to go up? Because this sideways is a waste of time. I can be in something else that's going up or down rather than just getting stuck here for 6 months. And that's the same thing when I look at gold and silver. It looks like something that will just stay stuck for 6 months at least. Oil probably going sideways for 3 months until we can continue going up, but we can continue going up pretty high. All right, that's it. That's a summary there. I bought a Koyo Po what? Crypto. They were that one making money, but pulling it out, I lose any gain if put it in stocks. Man, yeah. I mean, it depends on how much money you have right now. You know, so yeah, hold up. We'll talk about that. Okay. I look for candles, typos. Oh, you look for candles. Yeah, I see. It depends, I suppose. I mean, supply chain and base it on oh, okay. Yeah. Yeah, that's gonna have to be doing something. My quarter has covered from low mild drop early this year. Yeah, it's mostly sideways, right? Yeah, most people don't care. They won't care. They wouldn't care. There's nothing really to worry about because from an S&P standpoint, if you look at the S&P, it's just flat, right? That's it. Nobody notices a damn thing. It looks noisy in the last month, but if nobody looks at the portfolio, who would notice a damn thing now? And that's why I don't like shit like this. If it's going sideways, I'm going somewhere else to make money. That's why I said oil, right? That's why oil you. Yeah, this is better, right? So something that goes sideways for 3 months, I'd rather be in something like this that goes up for 2 to 3 months. So that's why I'm saying like go to software right now. Oil will probably go sideways for 2 to 3 months. I'm going to software, going up 2 to 3 months. Then I'll get out, go back to oil. That's how you make money. You keep rotating, going around and around and around, and that's how you make money. Because most people they just want something that's automatically going to do that. It doesn't. You can pay people to try to do that, but they'll charge you an arm and a leg, probably, right? I'm charging you nothing for telling you this stuff. It's free. My advice is free. You can take it or leave it. So that's it. Okay. Let's see. I bought holding stock. Ooh, okay. Huh. Yeah. Just keep watching. The more you watch, the more you see what I'm doing. Then you'll pick it up as you go along. That's the best thing first. That's definitely for sure. So let me put this down. I'll look at this when I have time. Because today I have to get through a lot. So I can't do anything right now. Let's see. Okay. Okay. Yeah, I know. She keeps changing her targets. Delta spill. Ditto. Yep, ditto. Yeah, she keeps changing her things. It's not fun. Okay, so if you want to sell your crypto, I think crypto will. I mean, okay, the problem is Bitcoin will go up, Ethereum will go up in the next 2 months, over the next 2 months into June. The problem is if you're in something else outside those two, it's hard to say, right? Litecoin probably will follow it. Ethereum Classic. What's the other one? I don't know. Ripple might go up. I don't. But the once you get past those, you go to the other ones. Solana, I guess, will go up. But I mean, but after that, you don't know what the other ones will do, right? That's the problem. They once the bull market in crypto, because it was last year. The summer of last year should have been a bull market for crypto. Once Bitcoin stopped going up, it should have transferred over to everyone else, but it didn't. That's the huge pattern. So I don't know. It looks like everyone just ran to AI. It looks like that's what it is. Everybody just ran to AI. They don't care. Yeah. They don't care. Um, it's the same crowd, I think. It's the same people. Like people either want aggressive software companies or crypto. And aggressive software companies have something to do with AI, and that wasn't doing well. Bitcoin wasn't doing well. Then everybody was just scratching their heads confused. I don't know where that money went, honestly. I have no clue. Like, I don't think they went to oil. I don't think that's the same type of investor. They really will look at oil and they'll be like, hell no, I'm not going to buy that. Chevron looks boring. Well, yeah, Chevron went up like 50, 60%. If you use options on Chevron, it's not that boring, right? If you use options, but so I don't know where that money went. It seems like everyone got scared out of it. Okay, so again, let's look at where we're at here. So I recommended 2 weeks ago on Monday, right? AIBU, WebL, right at the bottom. I told you guys on that Monday when it dipped down here, pretty good so far. If you held it, you're fine. If you didn't sell it at the taco, you're fine. I think this thing will keep going up as long as the market stays okay. That's not guaranteed though. Okay, that's not guaranteed though. I have no idea about the Hormuz Strait. I don't know if these stocks even care about it. Honestly, they shouldn't. They shouldn't. This should stay flat or keep going up. The only thing that will affect this stuff is Anthropic, Claude. Uh, what's the other stuff? Agent, managed agents. I don't know. All these people talk about AI all the time. I have no idea what they're talking about anymore. Like every minute they're talking about something new. And that's about it. I don't think it has anything with Hormuz anymore for these stocks. It will have something to do with semiconductors. Yeah, gold, I guess, depending on how it affects the bonds and currencies. And oil stocks, I think, are stuck. That's definitely, they're just stuck because I think anybody who wanted to buy oil stocks already are in it. That's why you see nothing anymore. There's like barely any movement. uh, People are just trying to figure out, oh, should I buy this dip or not? And let them figure that out. I don't care. I'm going to come back in June. I'm going to go to software. I see Oracle pop in. I see like everything else pop in. Like you see NetG. So this is 2x leverage of Cloudflare, 20%. Like you could have picked any of this and you would have made a ton of money. It was just like anything at the open, buy it, buy it, buy it, buy AppLovin, buy. Yeah, this is crazy. So it looks good to me. So I'm gonna add 2 more, right? Oracle. Okay, so we're gonna add this one. So you can add ORCU and ORCX. So it's on the banner in the ticker. Okay, and I'm gonna go over it again because I made a tweet. This is what I'm gonna do, and I'm gonna add also Adobe because now we have this Adobe ETF 2X, which is fairly recent. I'm gonna add this one. Okay, too. So ADBU, ADBG, same thing. They're both 2x leverage. I don't know, up to you which one you want to pick. This one's like cheaper at $4, I guess. I don't know if that matters to you guys if you don't have much money, I suppose. And then you got CRMG. So this is CRM leverage 2x. Might as well buy it. Now I see there's a now. So service now leverage ETF, but this one kind of looks ugly. but maybe I'll add this later. So there's definitely one I see, NOWL. Okay, so this has been going straight. This was made in July. Maybe it's time to get in because maybe it'll pop back up. I don't know. Shoot. So I don't really care. I don't know what it does, but I just look at the chart and it's like it's ready to go. It's ready to go. It's coiling up. This is coiling up. We got to get ready. So any stock in this ETF could be pumping just because there's just too many shorts. And you just buy it and it just zooms up. And you don't know why. You don't care why. I don't care about news about this. You can say whatever you want. But it was like 14 when you said buy. You can't predict nothing. That's why every day you got to look at it and go like, what's the day today, where it is. Yeah, I have a tweet. What? Yeah, I mean, you look at the description, I put my Twitter handle on there. Yeah. Don't you see me going on Twitter and showing you stuff? Where do you think I get that stuff? I have to have an account to see posts, Elon forces you to get an account. This account I have is just an old one I made in 2016 to troll people. It's basically a black dude. So I troll people saying like I'm a black MAGA guy, and I just used it to troll people. And then once Elon made everyone required to log in to read posts on Twitter, I just figured out how to get access to it again. I had to call Twitter and be like, I forgot my password. There's no phone number on it. Can you just figure it out for me and get me my account back? So yeah, my junk account I got back like a couple years ago. You never noticed. What the heck? Come on, guys. Jesus. Anyhow, yeah, we're done with that. Okay, so let's go. Let's just go to the tweet then. How about that? How about that? I don't know. Somebody's throwing Molotov cocktails and shooting up Sam Altman's house. I have no idea. I guess people be cray now. They don't want that AI revolution. Huh? They're taking their jobs. They're taking your jobs, man. So synthesizing a leverage IGV and Sky ETF. So yeah, that's my thing. And if you look at the banner, there's my Twitter right there. Eric Foreman, MD, from Dr. House. That was me. And I was using that just to argue with people online for fun. But it got boring after 2016, so I didn't care anymore. I forgot all about this account. Anyhow, but yeah, since Elon did his thing, okay, I reactivate it. Might as well use it again. Okay, there we go. Okay. So, those first two, right? AIBU, 2x leverage, AI big data. We have WEBL, 3x leverage of the FDN ETF, which is the Dow Jones Internet Index. Now, these two don't really make much of the IGV or Sky, so you need to start adding these things. CrowdStrike, Palo Alto Networks, Palantir, okay, Oracle. So now you have these leverage ETFs you're going to add to it. Okay, now here we have this tweet. Software stocks now make up just 1.4% of total U.S. net exposure, down from about 7% at the start of the year. That is a sharp reset in positioning. So it's very underweight software. Everyone got out. Nobody's in these damn stocks anymore, which makes them easy to pump. So even if Warren Buffett thinks they're overpriced still, I think they're overpriced still. Palantir is way overpriced for sure, but doesn't mean it can't go up anyway. So that's the thing. So, and then we add these like NetG, I talked about yesterday, Net, and then APPX, okay, CRWG, CRWMG. So make sure you know the difference between the two. One of them is CoreWeave, one of them is CRM, Salesforce. CoreWeave actually works with Anthropic. So this one was actually going up while everybody else was going down for the last several trading days. Adobe, okay, ADBU or ADBG. Okay, that's it. So those are the ones. So you can go to the tweet right there. All right. So follow me and then you can get the tweet. But I'll be putting that in the Substack in more detail because I got to figure out where exactly we want to buy if the market pukes in the coming 2 weeks. We still have 2 weeks. All right. I don't think the market's just going to go straight up. I don't think so at all. So you got time, but you can trade these in the meantime, though. So you could have traded them for Friday. I did Friday with Palantir, and you could have did this morning. You could have bought anything, and they would have went up 10 to 15 to 20%, because all of them did that. That's it with the 2x leverage on all those stocks. Okay, so you got that. Good. So now there you go. Very easy. He broke Knitter. You didn't notice that? So when Musk came in, he took away all the APIs. Knitter was broken for several months. So nobody could use Knitter either. So it was very annoying. And I said, all right, fuck it. I'll just try to open up my account then to read people's posts. So I guess you missed that too, Eric. Yeah, Knitter was broken for quite a long time. Every time I fixed it, it got broke again the next week. It was really annoying. I was like, fuck this. I can't use Knitter. I can't use the archive. I can't do anything to read posts without having to go through Twitter itself. Then I might as well just get the damn account working again. So he did it. Musk worked. He got me to reactivate my account. All right. Anyhow, let's go. So that's what I did. So I might well use it to troll people again anyway. I think the next coming 2 years is going to be very eventful. A lot of activity. All right. So let's take a break and let's see how the Zoomers are doing.
Out! I'm fucking stressed. We should not be working like this. I work my ass off and I can't even fucking pay bills, bro. And they always say don't compare yourself to others, but I see people going to Chicago, what the fuck, Coachella, and fucking like buying all types of shit, just pointless fuck you money, and I'm over here getting.
Yeah, well, I think this generation is cooked, honestly. I don't think we can do much about that. Yeah, apparently there was this guy too.
Can you open this door, please?
For what?
I just want to make sure that everything's okay. There seems to be something going on.
What do you mean?
I don't know. I just figured I'd check on something.
I don't know what you want, man. Get out of my house.
Open this door. Where's your daughter, man? Where's your daughter, man?
What are you talking about?
Where's your daughter? Who's in there with you?
Bro, if you don't
Open
leave...
this fucking door. Open this door. I'm breaking it fucking down. You understand me?
Leave my house. You don't...
Are you okay? Is everyone in this house okay?
What? Everyone's okay. What do you want? Can you leave my house, please?
You open the door, please.
You have nothing to do with my house. Can you leave my house?
You know what my name is?
I don't know who you are. You don't belong in this neighborhood. That's for sure.
This is my neighborhood, though.
Yeah, I live there. I don't know you.
My name is Harry Dresden, motherfucker. Open the door. This is my neighborhood. Open the fucking door. Now, or I will fucking end you. Do you understand me?
Yeah, y'all crash it out. Oh man, crash it out. Everyone's crashing out. Wait till you get massive inflation coming back into the thing. Oh yeah, you all gonna crash out. Watch. So protect yourself. Protect yourself, guys. There's gonna be a lot of crash outs coming soon. A lot of people can't be affording their avocado toast, all right? They be crashing out here.
Victor, you around? Huh? You like big little girls, bitch? Huh? You fucking try me, I swear to God. Do you understand? You're screaming, there's no one out there. Get the fuck out of my third room, bro. Walk the fuck out. What's the third room? Walk the fuck out. I'm telling you, I'm giving you a chance right now, man. What's the third room? I'm giving you a fucking chance. Get the fuck out of my house. What's the third room, bro? I'm telling you, get the fuck out of my house. Please. Just answer the question. Get the fuck out of my house. Just answer the question, please. There's no one in there. There's 3 rooms, man. I don't know who you are. You better get the street at 1797 Co-op Drive. I don't know who you're talking about, man. Why do I hear screaming? Are you military? Yes. Okay. Can you help me out? Okay. Yes. I understand what you're going through right now. Yes. Can you step outside? Yes, sir. Thank you. Will. Thank you for asking. There's something going on this street, bro. Bro, everything's fine. Please step outside. Okay. Well, sit there. Sit on the ground, please. Yes, sir. Okay. How you doing today, sir? Okay. There's a little girl trapped in this house. You will check her, please?
Fairfield Police, is anybody inside?
Fairfield Police Department. They said they were not inside. Fairfield Police Department.
Oh man. Shit. My God. Anyhow. Yep. Guess we're gonna get more crazies out here. Yep. I think that's what's gonna happen. There's nothing we can do about it. People are just about to crash out anyway. The economy is going to go to shit in 2-3 years. Inflation's already rising again. Okay. And that guy's in California. Probably his parents can't pay $8 per gallon diesel. Right. Gas is already $5-6 already. It's not even summer yet. Yeah, great. Everybody's going to get squeezed out. And I think pistachio prices will be rising too. Iran is a major producer of pistachios. I don't know. Anybody here eats a lot of pistachios? That's gonna be great. California can grow pistachios, but then they'll be complaining about the water usage. Pistachios consume way too much water. All right, guys. Zoomers be wildin'. Yeah, they be wildin', man. They be wildin' for sure. Okay, let's go for it. Okay, so what I'm going to talk about in this stream, if we got time to cover this for the rest of the hour and a half. Okay. Is it this thing? Oh yeah, okay. I gotta watch this video for you guys. Okay, that's important. We got this one, and then we have this. So let me tease you a little bit, okay, before I play this video. So there was a presentation today with John Bollinger, okay, famous for creating the Bollinger Bands. So I'm gonna play some of that video. But last time we were talking about triangles making waves, right? They can describe sinusoids and whatever. And sinusoids are the components of the summations of which creates waves. This is what was discovered in the 1800s by Fourier, okay? A French guy, all right? And this is why I mentioned that pyramids, like the one in Giza, you know, they represent a lot of ratios that are very important. We have the golden ratio, we have pi, we have lots of things there that can be seen. And there was this guy named W.D. Gann, who was also around the 1800s into the early 1900s, who developed astrology, you know, to predict markets. He was looking at Venus. He was looking at Mars. He was trying to predict grains, okay, corn, wheat, using the planets, all right? Later on, there was this guy named Elliot, okay, who created the Elliott wave theory. And I briefly talked about it a little bit. 1, 2, 3, 4, 5, ABC, okay? So there are people that are very serious about these methodologies. Very serious. I personally am not going to be very serious about these. But with the DeMark indicators, yeah, I can use DeMark to use Elliott wave, okay, using through his system. As far as W.D. Gann, you know, a lot of people, you know, have mixed feelings about this. Like, what the hell is this shit? Like, are you guys kidding me? You're telling me that these squares here can tell me where the price is going to go? So price and time can be talked about through just this type of stuff? Is it really serious here? Yeah, people do think this is serious. Okay, so now, what's up, Roller Skater Texas Girl? So let me remind you what I played yesterday. Okay.
Phenomena that propagate in the form of waves, or can be described by the concept of a wave. To understand these phenomena, we model them mathematically. It is remarkable that the mathematical description of a wave, even when solving complicated differential equations, can be traced back to a simple geometric shape, the triangle.
Okay, that's what we covered yesterday, right, with this video. So you can go back to yesterday's video and see this. And then towards the end, we figure out that trigonometry leads
As
to...
we approach an angle of 0, the length becomes smaller and smaller. At an angle of exactly 0, the opposite side disappears. But we can imagine that it's still there, just with a length of 0. If we now rotate around the entire circle and trace the path, we obtain this curve for the sine. Here, negative lengths mean that the opposite side is in the lower semicircle. And that looks like a wave, doesn't it? Simply copy the coordinate system and offset it by 90 degrees, because the adjacent side...
Okay, so that's enough of that. So as you can see, you can describe a wave with right triangles. All right. Now, you know, the conception of sine and cosine came from Indians, right? So it was Indian mathematics that described it that way. The Greeks kind of had it a little bit, but they called it the chord system. The chord system didn't use the right angles. It basically used the full chord to describe it. So you had to divide that by 2 and do it the same way, but then they would have to use tables. But the Persians, who were in the middle between the Greeks and the Indians, had both knowledges. And then from that time, they combined the two. So that created the concepts of cycles and waves, as well as spherical trigonometry. And that was what they used to describe how planets moved across the skies. So, and if you remember from the Bible, you know about the Magi, right? You had the 3 wise men. Who were these wise men? They were Zoroastrians. They were Persians. Those were the 3 wise men. Okay, get it now? And from there, they can look at the skies and predict the future. Who was going to be king? Who was going to be doing this or that? What was the right time to marry? You know, that's where astrology comes from. So everybody who was looking at the sky tried to use that to divine the future. All right. And all these maths that we have here, okay, come from that system. So can we predict the future with this type of stuff? So let's see. All right. Let's continue on. So this is the video that was played today in the FSC, the Foundation of the Study of Cycles. So they had a presentation with Bollinger. Bollinger, very famous for creating the Bollinger Bands. All right, so let's play this.
To another episode of Cycles TV. Today we have a special episode and we have a special guest today. So we will have John Bollinger with us today, and I'm very happy to have you here, John. Welcome, John.
Oh, thank you very much for having me. It was a pleasure to be here.
Yeah, so, and not just here, so we are also pleased that you will join our conference, Cycles in the City, in New York at end of May. So we are very pleased to have you there, and also then meet in person to have a real talk about the cycles and technical analysis. So thanks for supporting the foundation.
I'm really looking forward to the conference. There are a lot of people there that I want to meet and chat with. I think the thing about these conferences that people don't really think about that much is that they look at the list of presenters and such like that, and they say, oh, I want to see this one, that one, the other one. But the real opportunities for me is the opportunities to meet and greet and chat with other people like-minded and exchange ideas. You know, it's really a great opportunity, I think.
So yeah, they'll have a conference in New York. I don't know if you're interested or not, or if you're in the area. I guess you can pay the $1,000 and get a ticket to go see these people. So they're gonna be like Larry Williams will be there. There'll be other people, like pretty famous traders, and yeah, you can go talk to them if you want. See what they're thinking about, how they do things. So yeah, let me skip ahead.
An option trader.
Okay, right here.
Which like Microsoft Basic or something like this. Yeah. So I was never able to do that. I knew some other people at the time who had done some work on on mainframe computers and such like that, Fortran and other languages that were more amenable to that sort of work. But that was beyond me. And at the time, I was an option trader. And I discovered that volatility was indeed volatile. Back in those days, we thought volatility was a fixed quantity, like the house is blue or the IBM's beta is 1.2. And one day I copied a formula for standard deviation down a price column in spreadsheet. I saw that volatility was changing, and I thought that could be a way to set the bandwidth automatically. It turned out that it was in the air in the very early 80s. Everybody was starting to realize that volatility wasn't the fixed quantity we had previously believed it to be. And in fact, the Nobel Committee ended up Nobel prize to Robert Engels for his work on inflation data. And that's the origin of those models, Arch models and Garch models, and such like that. So that's how I got to Bollinger Bands, and they worked as. But what I discovered over the years, which would be most of interest to you, is that volatility was cyclical, not in the way normal people think of cycles, and with a nice smooth sinusoidal shape and a regular time period. But volatility was cyclical in that high volatility was a forecast for low volatility, and low volatility was a forecast for high volatility. So it was, rather than being mean reverting, which is how a lot of people think about security prices, such like that, volatility is actually extreme seeking. It either seeks to very, very high levels or very low levels. And that tied right back into that cycles work that I had done when I first started learning the business. One of my great moments, I went back east at the time, the Market Technicians Association, as it was called then, was hosting the Cycles Library. And I remember to this day, the day I walked up to Wheeler and Shirk's great big cycles book, the big green monster cycles.
Yes.
And started leafing through it. I spent hours and hours and hours leafing through it, and was just astonished by the work they had done. This is all done by hand, and under the most arduous circumstances on Collamer pads with pencils, and later on they had calculators, but in the beginning they actually did the math by hand too.
It's incredible. It's incredible, isn't it? I mean, we have that green book in our archive, and we also visited that. It's fascinating. Yes.
Yeah. So that was a real thing for me. So I've always been interested in cycles. I mean, I suppose my interest started like any kid's interest starts. The changing of the length of the day over the year, the cycles of the moon, the tides, the winter versus summer, all these things, you see all these cycles around you, and you start to think about them. You start to think about the effects that they have and such like that. So I think my journey is probably, a very, very typical journey of somebody who's noticed cycles around them.
Yeah. So maybe getting back a little bit to your adaptive method, you described using volatility those days and trying to use volatility and then standard deviation based on that to derive the width of the bands, and that was the approach by that day you mentioned. We also in the foundation are thinking of ways to improve technical analysis on different indicators, because one main concept of every technical indicator and also your Bollinger Bands is you need to decide for a specific length for the calculation. So the average you use a 20 period average for the basic calculation or whatever, or an RSI 13, 14, whatever. And I mean, I don't know how you think, but most people never questioned how to set the right length. It's one of the most important parameters to get your technical indicator right. But what about the knowledge to set the right length parameter? So you decided, or you recommended the length of 20 in your main knowledge. And we have found that there are different ways also to use cycles, to use also an adaptive length based on the dominant cycle.
Good.
Instead of a fixed length. What do you think about that?
I think it's a terrific idea. So, back in the day, the 21-day moving average, I chose 20. I'm not sure why. It was 4 weeks of trading days or something like that. But 21 was a very commonly used length for stock market work and market timing work. And I always ask people why that was. And the explanation that I got that seemed to make the most sense is that it was based on the lunar cycle. So I don't know whether that's true or not, or whether it's coincident or not, but I always found it interesting. And that's been ticking away in in the back of my head. And I remember Jim Tillman's work was so interesting, and you know, so many other people who have done work on cycles. Chris Carolyn, these guys have done just fantastic work on cycles. Chris Carolyn's tide work, you know, it's just really, it's really super interesting. I think the idea of finding a cyclical component in the data and using that to set the length of the indicators you're using, as you've done in your work, is a terrific idea. And I think we'll be hearing a lot more about that in the future.
Yeah, I think it's a little bit of lost knowledge in technical analysis, and we want to bridge a little bit that gap, bringing knowledge about cycles and how to use cycles also across the group into the technical analysis community. Because what we found, or my specific analysis, was you can improve the RSI by using the dominant cycle length to adapt the RSI setting, and it improves by a huge margin the readability of that indicator. And as you said, I mean, there could be an rhythm introduced by the sun, the moon, or whatever. I mean, we don't know the root cause, but if we can observe that length in a data series, for sure it makes sense to tune to that rhythm, and then have our indicator adapt to that rhythm.
So for me, not knowing the root cause has always been somewhat of a problem. It's something that I think about all the time, and I've been attracted to many you know, cyclic phenomenon where we have some idea of the root cause. Day of the week, for instance, some stocks are weaker on different days of the week. The market has patterns over the days of the week. It has patterns over the hours of the day. It has patterns over the days of the month, and it has patterns over quarter end and quarter beginning, as well as annual patterns and 4-year patterns that are, you know, function of the political cycle. So for each of those, that you can sort of speculate that there's some sort of motive reasoning. And I find those easier for me to digest and understand and deploy in our work. I used to have a website called Pattern Trader that delivered, you know, information about all of those ideas to help traders. And what I think of it, my work is background information or environmental information. So it helps us figure out which way we're going to bias our operations.
Yeah, I think what you talk about are also seasonal cycles, right? So different perspectives of the year, or different 4-year cycle, or even weekly cycles, daily cycles, which get into the seasonal type of cycles. I think there are always those two groups. I mean, with digital signal processing coming from an engineering perspective, you don't need to understand the root cause. You can just measure if there's a cycle or not. So,
but don't you wonder about it? Don't you?
For sure, for sure. That's the fascinating part. I mean, the data speaks for themselves. Yeah, it's just pure engineering, mathematics, signal processing. But then the other question is, okay, what is driving that cycle? Where's that rhythm coming from? That's what data is not telling you.
How do it do that, right?
and that's then really a type of science where a lot of research needs to be done, and there's a lot of unknown in that area, and there's huge information gap we have. So that's why we all need to bring our ideas together to better understand what is the root cause for those cycles. I mean, that's the holy grail. If we can explain those rhythms, that's fascinating. But getting back to your, as you mentioned, your patterns, and you also have that method that Bollinger Bands are used also to identify information. And now let's talk about that patterns in price is what technical analysis, your indicators are also designed for to easier spot. But cycles are working on the time dimension, not on the price dimension. So, and we think, or I would be interested what you think about that, so that combining the information what cycles can give you, timing, when to expect a possible top or a possible bottom in terms of time, not in terms of price, and then combine then with a price-based perspective of a pattern, a topping pattern and price information, or a bottoming pattern and price information. If that appears on a point in time where a cycle has a bottom, and then a price pattern was also in alignment, maybe visualized via the Bollinger Bands, wouldn't that be a match in heaven, to combine cycles and timing? And
that's exactly what I meant to say before when I mentioned I thought of them as environmental information, so that you can bias your operations. If you feel that an important cycle is bottoming, and you see a bottoming pattern in relation to trading events, then you have a higher confidence in executing. I think that could be really interesting. It's interesting that the pattern trading aspect of Bollinger Bands came later. The first thing we tried to do was compare price action within the bands to the action of an indicator, like an accumulation distribution indicator or a supply demand indicator. So if we tag the upper band and one of those indicators was negative, we would think of that as a sell alert. If we tag the lower band and one of those indicators was positive, we would think about that as a buy alert. I wonder if we couldn't do the same thing with cycles. If you tag the upper band and a cycle is turning down, then you would take that as a sell alert. And if you tag the lower band and the cycle is turning up, that's work that I haven't done, but I speculate that could be a really interesting area for study.
Yeah, that's the path we try to take to combine technical analysis, which is, to be honest, an 80-90% price-based analysis, not time-based analysis, and to combine that with cycles from a timing-based perspective. And exactly what you phrased as environmental information, this is what cycles can give. And this is what we try to plot together on a chart. That's where we as Foundation now are heading forward, to bring both information on one screen. So right now you have often two applications.
So it's interesting. Most technical analysis is done on a monotonic price scale, but it's not always been that way. Back in the 30s, many people put volume on the x-axis. We have the work. I have a fantastic. Let's see if I can see it. Yeah, here it is. This is a chart book from the 1930s done by Edward S. Quinn, where he
All right, so this really got my interest. You see this? They plotted volume on the x-axis. They didn't care about time. There's different type of charting techniques out there that most people don't use. One of them is called Kagi. So Japanese Kagi, Kagi. You can look it up, and they base it only on vol. I guess price, whatever. But you could probably modify the Kagi to only do volume. So where like you ignore everything else unless there's big volume, right? So if you remember, like when I do the charting now, and I talked about the volume weighted, or what was it called, the auction model, and then I made the candlesticks fatter when there was a lot of volume, so you can see right away, whoa, that's a big area of interest because of the volume. Now I could just eliminate time altogether, right? I could just say forget time. I don't care about time. Anytime there's like some volume, that's when I really care about. So I eliminate all the data about what day, what minute, whatever, and all I care about is looking at where the significance is in terms of volume. This is curious right here. So I think we are in a time where we can explore all these things. And cycle research hasn't been very active. Okay, a lot of these people here who worked in the foundation, they left. All right, the foundation went away, and only kind of like a few years before COVID, the foundation got reactivated by these people that came in. So they actually have the access to all the old data. So you're talking about like, oh, could we make a giant library or cycles? Well, the data has to be digitized. So these people have come in. They're going to have to go through all these old books from way back when and digitize everything. But I'm sure all the billionaires already have this data, but they don't share it with anybody else. Data is money. If you have stored data that you accumulated, you think you're going to share it with everybody else for free? No way.
Puts volume on the x-axis instead of time. So, I think that exploring different domains on the x-axis could be super interesting.
Yeah.
The way I got to where I am today was by recognizing that something that was commonly accepted was wrong. So my recognition was that people believed that volatility was stable, right? For example, in options trading, if you wanted a volatility estimate, you just took half the 6-month range, right? And you didn't bother to update that, right? That was just a good volatility estimate because you thought that the quantity was stable. My insight was the volatility wasn't stable and that it could be used in unique and interesting ways. So, questioning what's on the x-axis and how we deal with the x-axis and
yeah, that's. I mean, there was a time when. There was a time when you mentioned volume-based charts, right? So the x-axis is plotting increments in volume and not in time. So doing that, it would allow us to detect cycles in volume. So which could completely deviate from a timing objective. But if there's a rhythm in volume up and downwards, it's a different pattern. Yeah.
And I think that I don't know with all the automated trading that we have today if the volume. I've always been fascinated by the idea of volume cycles. I've never done anything about it, honestly, but it is something that I have thought about at length.
Yeah, we did it, but there was not a big community around that who was interested in that. I mean, but as you mentioned, maybe it's a lost area. It's not the common sense. Maybe it's worth paying more attention to those areas again.
I think when things are accepted as granted, just as facts, smart people, thinking people will want to question that. So there's lots of things that we think of today as facts about the market and such like that probably are wrong, and that by turning them on their heads or seeing how they're wrong, we can make tomorrow's innovations. I don't know exactly what those might be, but I'm sure that there's some 18-year-old out there looking at a chart going, why do they do it that way? Wouldn't it be more interesting to do it this way? And that's going to be the big name. That's going to be the big name of the next 20 years.
It is, and I mean, we also can challenge why do we think that time is always linear? No? So also time, maybe we always plot it as a linear scale. So there are also different things to do with that.
Well, I can tell you that as a guy who's getting a little older in life, time, it doesn't seem to be too linear to me.
Right? Time is not linear that way, so maybe there's also something in that. So, but maybe, I mean, we try to find ways to improve technical indicators. Let's get back a little bit, just for a moment, on your Bollinger Bands. So you use the standard deviation to have that adaptive with. What do you think? I mean, today, and you mentioned those days back, you didn't have the computer tools to use more sophisticated approaches on that. Thinking or starting today with your same approach, would you think, and cycles detection is really not a big thing these days. So using cycle detection approach where we can measure the amplitude of the most important cycle, and using that amplitude as also measurement of volatility, and using that then for the width of the band instead of a fixed standard deviation and pattern. So starting these days with computer power, would you think that makes sense to even improve your Bollinger Bands?
Of course it would. One of the things about having created Bollinger Bands is the joy of all the wonderful ways people have taken them and made them their own. I've seen very short versions of Bollinger Bands. I've seen very long versions of Bollinger Bands. I've seen Bollinger Bands with every type of average that you can imagine used as the median point. I've seen, population standard deviation, which is my choice, but I've seen sample standard deviation used. I've seen people compare average true range to standard deviation. I just seen tremendous amount of innovation around this basic tool, and for me, that's a great joy, to see people, pick them up and run down the road with them. The way I do and what I do is fine for me, but it's a big world, and there's a lot of people out there, and there's a lot of things to be done, and a lot of different markets to work in and think about. So anything that can improve the results for people, I think is a great idea. I'm expecting you to teach me how to adjust the band length with cycles.
In New York, we will talk about a cyclic tuned Bollinger Band version, and we will spend some time on discussing.
All right. So if you want more, go to New York. I think they'll talk about it over there. So they'll be working on it. And so the foundation, it's a reboot. From Edward Dewey. Edward Dewey was the one who started the foundation, but they went dormant for many years until recently. So thank God these guys have done that, because then I don't need to do the work, because a lot of people wouldn't do this type of work by themselves, right? You have to gather the data. You have to develop the algorithms to figure this stuff out. I've seen a lot of people do cycle stuff. There's her cycle channels out there. There's this Norwegian guy out there, JB Cycles. None of these guys ever convinced me this stuff actually worked well. They always had these ad hoc rules. I never took them seriously. But when this German guy took over all the technical work, it's like, man, he's an engineer. He's thinking like an engineer, like I would. He's applying it the right way. Man, I think this is actually going to work. So before somebody serious came in to do this, it was basically astrology. So let's go back to this, right? You see all this like pyramids of Giza, this stuff and that. I'm just looking at this stuff like I don't believe any of this. That's why I never trusted any of the Elliott wave stuff. I never trusted any of this stuff, the Gantt stuff. But now that I have the DeMark indicators, okay, the DeMark indicators will help me with the Elliott wave stuff. And then the cycle stuff, I can replace whatever Gantt is doing. I don't need to worry about Venus or Mars or any of this stuff and worrying about like the square of the pyramid. Like I am not doing this. Okay, this is ridiculous. This is really BS, right? So that's why a lot of people don't really look at technical analysis seriously. When you go this, it's just like, what? But now that we actually have serious amounts of data, we actually have a systematic way of doing things, I think we can actually use this to help better time stuff. So I don't need to give you random things, right? When I tell you to buy certain things at a certain time, I really mean it, right? I told you like back in late February, early March, I said buy oil. And then after that, I was like, okay, let's do software like a week or two ago on that Monday, right? Now I'm doing it again. I've been trying to see if I can do better, because most of my own trading, I just wait for big bottoms and I go long, and then I don't think about it. I turn off my brain. But because like I started the show with John, right, talking about this stuff, I said, well, we're getting to the AI era. We have a lot of you guys that know AI. We have big data, because now like a lot of people are gathering data for their data centers going into AI. So big data is important. They're gathering a lot of information. We have access to things that we did not have access to before, you know? And so these old ideas might actually be relevant if properly used. Now, if we do it like this, where it's just like woo-woo, new age, whatever, crystal, this is essentially some wine on crystal stuff here. Like, I don't know what is going on. Like, if I'm gonna do Fibonacci sequences and all that and just be like, I see random patterns, it's like, come on, bro. Dude, I'm just looking at a cloud and guessing what it does. So let me read this for you guys. Okay, let me read you this long article. This is an old article. Is it related to what we're talking about now or not? Well, I think it's up to you to decide. So back in the probably late 90s into the early aughts, okay, BlackRock had huge data centers. One of them was underneath apple orchards in Washington State, maybe beneath where Jeremy was in his shack when he was talking to Grace. The monolith and the markets, getting $15 trillion in assets onto a single risk management system is a huge achievement. Is it also a worrying one? East Wenatchee in Washington State is known for its apples, not for its financial services. But in a data center nestled between the orchards and hills, a cluster of 6,000 computers oversees the assets of over 170 pension funds, banks, endowments, insurance companies, and others. Whirring around the clock, the machines look at what interest rate changes or bank collapses or natural disasters could mean for trillions of dollars of assets. Around the world, 17,000 traders have the computer's assessments of these risks at their fingertips. When they buy or sell assets, the data center forms the heart of BlackRock, an asset management company that is the world's biggest investor. Founded in 1988, it has $4.1 trillion in assets under management, making it bigger than any bank, insurance company, government fund, or rival asset management firm. It single-handedly manages almost as much money as all the world's private equity and hedge funds. Though its holdings are mostly equities, it is the biggest shareholder in half of the world's 30 largest companies. It also holds bonds, commodities, hedge funds, property, and just about anything anyone would ever want to invest in. All right. So, what do you think these guys are doing with all that data? You think they got a cycles program running on it? I'm betting they do. So they call this Aladdin, the risk management platform that occupies all those computers in the orchards. Is not just used to look at after BlackRock's $4 trillion. The firm makes its facilities available in whole or in part to managers looking after $11 trillion more, a tally that has recently been growing by about $1 trillion a year. All told, Aladdin keeps its eye on almost 7% of the world's $225 trillion of financial assets. This is unprecedented, and it means flaws in the system could matter to more than just BlackRock, its investors, and its customers. If that much money is being managed by people who all think with the same tools, it may be managed by people all predisposed to the same mistakes. BlackRock is, according to one of the architects of Aladdin, perpetually neurotic about risk. Company lore attributes this neurosis to a $100 million loss, which nearly ended the career of its co-founder and chief executive, Larry Fink. All right, Larry Fink is still there as CEO. A wonderkind of at First Boston, an investment bank, Mr. Fink had risen to its management committee in his early 30s after pioneering the art of repackaging income streams such as mortgage payments and car loans into bonds. First Boston profited handsomely from this pioneering work in debt securitization. Ooh, sounds familiar? Until an unexpected fall in interest rates wrong-footed Mr. Fink's traders. Mr. Fink was sidelined, leaving him time to ponder how Wall Street's titans understood the risks they took to make money. He set up BlackRock as much to offer clients a better understanding of risk as to manage their money. Originally a part of Blackstone, I think you guys know Blackstone, right? They own a lot of family homes and apartment complexes. They are the real landlords of the world. A private equity firm. It was sold in 1994 and floated in 1999. Today, it is worth $51 billion, making it America's 17th largest financial firm by market value. So this article is written around 2013, so it's kind of out of date. Okay, it's about 10 years, 15 years out of date. So anyway, let's continue down here. Let me skip some of this stuff. Blah 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 blah. Okay, anything else here? No, I don't think so. Okay, biggest 20 companies by market capitalization, blah, 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 blah. Okay, there is another way that BlackRock is singularly important. A recent report by the Office of Financial Research, an arm of the U.S. Treasury, contained a warning that asset managers, which provide consulting or pricing services to other asset managers, are creating interconnections and dependencies that increase their importance in financial markets. And through Aladdin, BlackRock provides such services on an epic scale. Who exactly pays to gain the system insights is not a matter of record, but a fair number of BlackRock's asset management rivals use it, as do banks, pension funds, and insurers. Deutsche Bank's investment arm, which manages 934 billion euros, announced in November that it was migrating to the platform, including those of BlackRock itself. Aladdin keeps track of 30,000 investment portfolios. Some of the clients use just the risk management services. About a third use Aladdin to manage their portfolios and process trades too. The $400 million the company can expect in annual fees from outside users goes a long way to meeting the costs of the system and the nearly 2,000 employees who run it. Aladdin, like the little sun machine next to the company's original fridge, is there to help. So Sun is like Sun Microsystems, which Oracle bought Sun Microsystems, and I think Oracle shut them down. So I don't know if they still use any Spark machines over there. They probably don't. Is there to help people who manage money understand what they own. An institution like CalPERS, like my parents, huh? That's what they get. That's their pension fund right there, which uses Aladdin to keep track of the $260 billion it has invested to pay for the pensions of Californian public employees. Needs to understand when its bonds will come to maturity, or how its assets will move if interest rates fall, or what would happen if a counterparty went bust. Aladdin is the tool it uses for the job. The system is based on a large and, its creators say, particularly well quality controlled trove of historical data. On the basis of that information, it uses Monte Carlo methods. Okay, I don't know. You guys, I don't know how many people here took stats or probability courses in college, but you can look up Monte Carlo And actually in engineering, you know, if you, let's say you have a silicon wafer, there is a probability that some part of that silicon wafer will be bad. That will affect the usage of the chips. It will also be that some of the fabricated chips on that silicon wafer will not work because something went wrong in the chemical process when they were doing etching and chemical vapor deposition. So you would use Monte Carlo to model how many chips you expect to be dead on that silicon wafer when you fabricate. So if you have it NVIDIA, right? They have large GPUs that take up a lot of space on the wafer. That means any type of defect on the silicon or any part of the process could create a defective GPU, and you have to toss that out. So you would have to use Monte Carlo and estimate how many chips you expect to survive being manufactured and going through test. Okay? And that will decide, like, oh, well, I can make a profit this year because I have enough GPUs that actually work after they come out of the TSMC oven, right? The TSMC is baking you those damn chips, and you have to model how many of those chips actually make it. So yeah, you would use the same Monte Carlo method to do that, just as you would in the stock market or anything else that requires probability, which produces a large randomly generated sample of the huge range of possible futures to build up a statistical picture of what could happen to all sorts of stocks or all sorts of chips, right? You could actually share the wafer with different chips. Like Intel could be occupying some portion of that silicon, NVIDIA another, Broadcom another, Texas Instruments maybe a part of that. Why not? Okay, they all share because everything goes through the foundry system now. Okay, to build up a statistical picture of what will happen to all sorts of stocks and bonds under a range of future conditions. These risk assessments cover both likely futures that matter day to day and less probable but highly salient ones. A portfolio can, say, be stress tested by being put through market turmoil modeled on that which followed Lehman Brothers collapse to see what happens. Users can see their portfolio's predicted response to a tapering of the Federal Reserve's asset buying program or to the onset of a global flu pandemic. Now, this was written before COVID-19, so I don't know how well that thing would do it. So, okay, that's enough. I think I got you guys a good idea. They have this huge data center with all this data. They're stress testing portfolios and whatever. And you think that they don't have some type of program that can kind of predict where interest rates are going to go, where dollars to euros are going to go, where yen is going to go, how many people are going to go and buy gold the next year? How many central banks are doing this and that? You bet they do. You bet they do. And they ain't sharing that with you guys. Okay, so that's why we're lucky to have the foundation of study cycles, because otherwise we're going to have to do this. We're going to have to do woo-woo stuff. I'm going to look at a pyramid and try to predict what the hell is going to happen tomorrow. I'm not doing that. We actually have data. We actually have algorithms now. We can do with AI now. AI could do this for us. We actually have the power to do as much as BlackRock, right? We have Claude. There's a whole bunch of people screaming and yelling that Claude is going to replace every cybersecurity company out there. I have no idea, but you guys are young. So why don't you guys take what I'm telling you now and go make your own Aladdin and predict your own stock market and bonds? You can make trillions of dollars with less people and less resources. If you know what you're doing, though. You don't want to waste your time doing something stupid. So I think this is an important time for you guys to learn, because one of you guys are going to be the next BlackRock. I swear. If you learn everything I'm telling you now. Yeah, never took stats, but I know it's used all the time in business engineering. Yeah. definitely is. There's something called the Pareto curve too. John Galt talks about the Pareto curve sometimes, right? The third, what is that? Pareto chart. What is the Pareto principle? Right, the 80-20 rule comes from this, right? I don't know if this actually is stats though. I guess, is it? Yeah, I mean, I know you guys heard about the 80-20. It's like 20% of the company. I mean, like 20% of the people in the company actually do all the work. Yeah, that's basically 80% is just dead weight. Yeah. I don't know how many companies you've been around, but I think you can figure that out. Yeah. Okay, that's enough. The link is in the description, so if you want to read the rest of this, it's this old article I read a long time ago. It's very important, I think, right now, because you see what you're up against. A lot of people don't bother to do any of this stuff because it requires a lot of work. It's way easier just to look at Venus and Mars and be like, well, it's in conjunction or it's in opposition, and then I can look at my birth sign, my sun sign, my moon sign, and then figure out where the stock market is going, right? Because that requires no effort, very little effort. But it's based on some truth. It's based on some truth. Yeah, astrology is based on something that once was real. And the problem is that most people will not take the effort to dig deeper from the woo-woo stuff, you know? And I think some of that woo-woo stuff is done on purpose to make people not look further into it, because people would just get a nasty taste in their mouth. It's like, oh man, this is some crystal, oh man, a age of Aquarius nonsense. See, that's how the rich people psyop you from not looking anymore.
Chatter, we're gonna ask questions about that kind of thing.
Yeah, so here's the thing. I am struggling with some of these high level math numbers because the numbers are just so big now. Like household net worth is 600% of GDP.
Yeah,
but it's not as if household net worth is overcapitalized. It's just that's how rich Americans are.
Yeah,
that 600% GDP is so big you don't actually need capitalism.
So I'm gonna play you this interview from Tom Lee. Tom Lee, who is in charge of, of Strat Fund Strat, something like that. He's always this guy on CNBC and Bloomberg talking about being bullish all the time. This interview was December of 2021, just before Christmas. Okay, so put that into context. This is just before Christmas, okay, in 2021, just before the big correction in the stock market. Okay, so he's very bullish going into Ukraine, the Federal Reserve raising interest rates, right? So this is the stuff that Aladdin is supposed to figure out. Aladdin is supposed to tell me, yo, if there's too much risk in being long in the stock market because of such and such or such and such event, I'm not going to take the risk.
Household net worth
to GDP.
So deduct mortgages, deduct credit card debt, just the assets themselves.
Yeah, so if you took so U.S. economy is, let's say, 25 trillion.
Okay.
Household net worth is 143 trillion.
How is that possible? Crypto.
So that
do it. Say it. Blockchain.
Crypto's only 2 trillion of that.
Okay.
But that number is like a real, like that's hard. That's actual residual book value.
What was that number in the 60s or the 80s or sometime?
It's never been this high.
Well, I don't know if this is exactly right. This is household and nonprofit organizations net worth divided by GDP. Is that sort of the chart you're talking about?
No, because if it's updated, it is all-time high. I'll pull it up on my phone.
While he's doing that, this surprised the hell out of me as well. The S&P 500 was up 18% last year.
Yeah.
I think it was up 30% the year before that.
Yeah.
It's up 26% this year. Does it not only does it
feel like that.
not feel like that? Guess what? The equal weight version of the S&P is up the exact same amount. It's not just mega cap stocks. They're each up 26.4% as of today.
I would not have guessed that. That's a big 2021 surprise.
26%.
Right,
that's a raging bull market.
Yeah. I mean, there are very few years way better than this.
Yeah.
Right. 2019 was an amazing year. This is coming pretty close.
Yeah. So here, guys, this is household net worth to GDP starting in. This is 1980, but we actually have it from 1950. But you can see
we're rich.
It's an explosion. We're rich.
Well, but not only are we rich, that basically almost never goes down. When does it go down? The GFC?
GFC, probably .com.
Yeah, it did go down a couple times, but
right.
But you don't need capitalism anymore, right?
What do you mean?
Because now there's so much saver capital, you don't need an economy.
We're self-sufficient.
It's centrifugal force. There's enough capital around already.
Yeah, where it's like oil. Imagine if you have we have the reserves. We don't have to import oil anymore.
What if you just had endless?
Yeah, I mean, so the U.S. essentially could be a supplier of capital to the rest of the world now.
Well, aren't we kind of already? Or
yeah, so this is why I think people should be quite optimistic, because essentially the capital that's accumulated now will be used to generate returns anywhere in the
world. Do you think most people feel that way, or do most people feel that the capital that's around now, it's only a matter of time before it gets destroyed in a bubble?
Wait, before you answer that, I also want to ask to dovetail off that. How have you been so bullish for so long? Because you've been optimistic, and I've been watching you for a long, long time, and I know it's very difficult.
In person, Michael's been following you.
I've been stalking you. No, we call it following these days. It's been very difficult to stay optimistic, especially in public, right? You get a lot of shit for that. How have you stayed? How have you kept your eye on the ball?
Some of it's just, a lot of it's our work, because there is, I think, like sort of larger structural factors at work that support the bull market. You know,
you and I talked about demography last time you were on.
That's right.
That's a big one for you.
Yeah, and like just a simple observation, like most major companies are founded by people in their 30s.
Right.
20 or 30s, like whether it's Costco, Blackstone, Bloomberg.
Is that true?
Yes.
Okay.
I have a chart that shows the age of the founder. They're all in their 30s.
Wow.
But what about
most people expect that?
What about things like valuations and peak profit margins and all the things that can go wrong? Like, do those? I'm not saying that you're not worried, but how do you like remain optimistic?
Yeah. Sorry, but let me just finish, because like, so if you have more people age 30, then you're going to have more innovation.
Okay.
And in fact, so we found that there's a relationship between the number of people age 30, 50 and the number of patents filed.
Is this just an American phenomenon, or do you see this elsewhere?
So the U.S. actually is one of the few developed countries with a demographic tailwind.
Okay.
Everyone else is going the other way. Like Japan, China, Europe are going.
Well, most amount of people in this country at a common age is what, 31 or something like that. All right, so we got them right where we want them.
Yep.
Okay.
So I would say, to me, if I was just relying on demographics, that means we have a bull market through 2029 or 2035.
So, but there are other people that study demography that would look at this, the same data that you look at, and they would say the baby boomers are going to sell all their stocks and sell all their houses, and that's going to depress the economy.
But you know that's bullshit.
Well, we know now in hindsight that that's not how things played out. But I guess my point is, arguments from demography solely can almost be made, like you can almost tailor your argument using the same data based on what you want to.
It's a reality distortion field, right?
It is, right?
Yeah.
But can we have peak earnings for millennials without peak earnings for companies? Or is that a non sequitur?
Well, the in between is really how companies allocate capital. And so that's like, if companies get too optimistic, then profit margins will collapse.
But they're doing the I know they're not. Not only they're not collapsing.
Because companies are actually overly cautious, so profit margins will keep expanding.
What do you got? What do you got there?
Okay, so this is the number of people aged 30 to 50.
Duncan, you have to get these charts from Tom later.
Yeah, but do you see the
Yes. Where are we now?
Where the orange line is. So it's turned up. By the way.
Okay, take a screenshot of this picture. This is the reason I'm playing this, because he had some pretty cool data that he showed on this conference. I'm not a big bull guy like Tom Lee. I'm not gonna say what my opinions are, but look at this chart. Do you see where it's turning back down? It's turning back down around 2026 through 2029. Right now. Right? There's a lot of shit on Twitter I've seen where people are going like, oh man, we have the lowest birth rates of all time. All the Zoomers aren't making kids. The housing prices are too expensive. The boomers are hoarding all the houses. All that stuff is going to accelerate this downturn. We had the biggest blow up and blow down from the boomers. And now you see the millennials now barely going up. It's already turning down. So this is going to be a headwind for growth in stocks for sure going forward.
The nadir, see this nadir? 2008.
Oh, wow.
Interesting.
That's very interesting. So we turned up when?
Yeah.
5 years ago?
And by the way, the nadir here was 67. Yeah, so it turned positive 2016.
Yeah, because these aren't people, these are consumers, right? Like let's call it what it is. This is a growing number of people who are in the household formation phase when you spend the most money.
And guess what? Peak earnings,
and also most productive in a way, right?
Peak earnings, peak spending. How is that not bullish for companies?
So personally, I don't think I'm at peak spending. I'm definitely at peak productivity. I'm just putting it out there. I'll probably spend more in the next few years, but I don't think I'll be any more productive than I was this year. Yeah. I can't imagine.
But take a look at this. See, this is the same chart below, right?
Yeah.
See the chart.
All right, take another screenshot of this. You hear that? Look at housing, equity markets, they also follow the demographics. So that's why they want mass yes, of course. It's all economics. Every time I'm on John Galt's or anybody's stream, I'm like, nobody gives a shit about races. It's all about getting free labor and pumping people in here to keep your middle class from shrinking. If whites don't make babies, then I'm going to figure out how to make another middle class somewhere else. That's it. I don't think anybody gives a shit about races, honestly. They don't even think that far. All that matters is how much wealth I accumulate and how many bitches I can bang with my shiny rings or flashy cars, right? That's as far as they think. There you go. It's all about economics. All wars are about economics, honestly. If you think it's because of religion or whatever, maybe that's the excuse. But really, it's about few things, right? I need pussy. I need fuel. I need freaking food. That's it. It's pussy, fuel, food. Pussy, fuel, food. That's it. So females, fuel, food. 3 Fs. That's, in the end, everything revolves around that. I don't see God in there. I don't see anything else. That's just an excuse people make. You want to rationalize it and have some high-flying ideas about, like, we're better than freaking animals. Good luck with that. Every type of base operation going on the earth is essentially the same as an animal. Come on. If you want to talk about God, then you could just be a monk and go meditate your way out of here, which is what I'm going to do. After I tell you guys how to make money, I'm out of here.
Above?
Yes.
That's rolling S&P returns.
That's crazy how nicely that lines up.
Yeah, so if this plays out, S&P's 19,000.
Wait a minute.
What would
we're at 65. We're at 65.
So this is where Tom Lee's crazy bull market stuff is, right? He's like, man, we're gonna get S&P 500 19,000. Are you serious here?
1,000 S&P correspond to on the Dow. Is that 80?
That's a triple.
Yeah,
so 100.
Well, S&P's like 5, so like 4,700.
Yeah.
So this is.
Oh wait, what did I say? What are you saying? Oh, it's
S&P going to
close
19,000.
to the quadruple.
Yeah.
And that's by the time the people who we just cited as being 30 now are like closer to 50.
All right,
correct.
But let's just stipulate that you're right and that these are structural forces. How do we survive bear markets? Because they're obviously going to happen. And are bear markets going to look more like they did in 2020 because there's going to be such a quick fiscal and monetary response? Or was that just a one-time shot in the arm?
And demand for stocks.
And demand for stimulus.
No, demand for stocks. I need more stocks no matter what. So when they're down 5%, that's like them being down 15% a generation ago. I'll just take them down.
Are multi-year bear markets a thing in the past? I know it's a ridiculous question, but what do you say to that?
Oh, I think there is going to be a horrific bear market, but it may not be for a while.
And does it have to last an average of 13 months, which I think is the historic peak to trough? Like, can it be 3 months and we say, okay, that was a horrible bear market?
Yeah. When I was at JP Morgan, we wrote a report called The Guide to Bear Markets.
Yeah, I probably read it.
Every major bear market is actually a retracement of the bull market. So 127%. Every bear market's 127% of the bull market.
Really?
Yeah.
So
So
it be that severe?
well, in other words, if you rallied 100 points, a bear market's 127 points
Down.
climb. Yeah. So you always you go below where you started, and then you're
Right.
27%.
But that subsequent bull market is then 500% of the bear market.
Correct. Yeah. So the
historically.
Yeah.
So
So
that's why it works.
Correct.
Okay.
But that level of wipeout, that drawdown wipes everybody out. That's why. So
Okay.
we'll have a bear market like that.
Not till 2024 though.
Or 2029. Yeah, maybe not till 2029.
Okay.
At the lows in 2020,
so we have time.
we were back to late 2016 levels.
Yeah, so that.
So all this is pretty funny when you go into context. This was late 2021, just before the peak, right? The first trading day of 2022 in January after New Year's, we had the peak, and then a couple days later, the market just slid down. The bond market went all the way down, and it was like it went down right after New Year's. So quite hilarious when you think about it. And then that's when you got all those articles that were saying they were worried about recession. You had everything that was screaming recession in 2022. Everybody was screaming recession by then. You had the Ukraine stuff, you had the rising interest rates, everything was going crazy. And by the time we got to early 2023, people were still screaming recession. but it didn't happen. None of that ever happened. We had 1 year of a correction, and we bounced right back. Okay, right into 2024. Okay, and then we got the next top in 2024, and then we got all the tariff tantrums, right? Tariff tantrums. Trump got reelected and all tariff stuff. And then we got April going down again, and then we bounced back up. And now we're back right here. Another midterm cycle, but instead of Biden, it's Trump, and we're at another war. Instead of Ukraine, it's Iran. So I don't know who's making this script, but they continually have this left, right motion now that's very tightly contained. It's as if they don't want this bubble to burst. They control when it goes down and let it rip again. That's why I don't believe this bubble will be popped in a way that's so spectacular. They learned from the previous bubbles, the real estate bubble and the .com bubble, and they learned how to manage it. They actually let the bubble rise up a little bit, crash it a little bit with COVID. Okay, that was the first test. And after COVID, then they went it with Ukraine, second test, and now they're doing with Iran, third test. So they make sure that we have this stair step. We go up, we go down, we go up, we go down, we go up, we go down. Eventually, it will stop working. It'll stop working. It'll eventually stop working. Will it stop working in 2029? That's the question. That's why they're hurrying up with all this AI stuff. They see that birth rates are going down. They see that they've injected as many H-1Bs as they could. Now it's up to the AI to take over, right? That's it. AI has to take over now. Can they keep the GDP going up with AI to replace whatever they lost now? That's the question. That's the question.
That's a huge retracement. Yeah, so I mean, I think we could we'll eventually have a huge bear market.
So I want to get into your outlook for 22. So you don't see that on the horizon in the next 12 months, which let's hope you're right. And I know when do you publish this?
When is this?
It's going to air tomorrow.
Okay.
So when do you publish next week?
On the 21st.
All right. Let's hold off on that. Let's get into the streets outlook, and then you could tell everybody why they're wrong.
Okay.
Our friend Sam Rowe is out with the usual suspects. I don't know how closely. Do you follow other strategists or not really?
I mean, people ask me all the time what I think of what someone else thinks.
No, I don't mean like what do you think of them personally, or if they're smart.
No. I know. I'm saying people ask me about their forecast, but I don't actually get people's research. So I know what people are saying, but I don't know their rationale.
Not even Barry Ritholtz's? I'm just kidding. So wait. So do you do that deliberately? Do you want to make sure that you don't get colored by other people's opinions and just keep that out of your purview?
The reason I don't do it is I don't want people giving my research away for free. So I don't want to read someone else's research without.
I heard you have huge beef with Brian Belsky.
Brian, oh, you mean in a dark alley? We fought it out one night at an Irish pub.
Not strategist wars.
No.
All right, so Mike, what is this showing us about prior year returns versus next year returns? I think you threw this in the doc.
I did not.
Oh, was this me? Okay.
My take on the strategist outlook is they're always kind of the same. And I'm surprised more people don't go bigger to one direction, because stocks are almost never up or down a few percent.
Yeah.
And I'm kind of seeing a lot of that. Like just eyeballing this, the biggest upside target that I saw was like 13% higher. Is that Yardini?
Yeah, I mean, I can tell you what some of the simple math I know that probably informs how we would think about next year.
I think you're more likely to be up 20% than up between 0 and 10.
Yeah, so the plurality of outcomes is double digit. Like, in other words, even if it averages 7, it's usually like...
But most people that sit in this chair, the strategist chair...
Predict 8 to 10.
Like, if you predict 20 and we're down 5, you look like an idiot, even if your prediction was closer to a historical outcome.
Yeah.
If you predict 8 and you're down 5, all right.
Yeah. So last year, at the start of this year, I would have told you the base case would be 20 because of the volatility collapse. But next year, the base case, if you do midterm math or returns after 20% year, it's actually like 11%.
Okay. Does it matter that this year was a 20% plus year?
Yes.
So, well, maybe it matters after an 18, after a 31. Like, we're just stacking monster years. Does it have to pause eventually? I mean, I guess nothing has to happen, but...
I mean, internally, as Josh was saying, it's already happened. I mean, a lot of stuff is peaked in February.
That's true.
So right, you go back to the market of stocks argument versus the index.
Well, JC will say investor enthusiasm peaked in February. And he's probably right on that.
So how do you disagree with? So how do you take issue with this from Michael Malbazan? Quote, this via Sam Rowe. If weak returns one year begat strong returns in the next and vice versa, then you should see a string of dots somewhere on the chart that slopes down to the right. We have that.
Yeah, we got it.
So meaning we should go down next year?
Basically,
this is showing that
total shareholder return, and then total shareholder return over the next year.
So it's just showing pretty much total randomness, more or less.
Yeah,
it's brownie in motion. There's nothing there. So how do you respond?
Wait,
to that?
hold on. I think I see something.
Yes, that's right. Buy it.
I would say.
Yeah. Well, let me finish sentence. Historically, there's been no discernible relationship between the returns during any 2 years as reflected by very low correlation. If there were anything to draw from this chart, it's the fact that most of the dots are clustered in the upper right quadrant.
And most of the time,
in other words, annual returns tend to be positive.
But there's probably more context that we could put on here, Tom. What do you think? What do you think?
A lot of context. I mean, I would put recession versus non-recession and business cycle.
Okay.
I would put midterm, and like election cycles in here.
Are you writing a lot about the midterm for your coming outlook?
Yes, to an extent. I think it's going to play a role.
Okay. I think it's going to be absolute fucking chaos.
Correct. That's why in midterm years, the market doesn't do anything in the first half. Usually.
All right. I'll end it there. So, yeah, that's why midterm years are pretty similar to each other. Most of the time in midterm years, nothing happens in the first half. And then everything goes to hell in the second half as we get closer to November. See? Which we see right now with the S&P 500. But unless you went to oil, you know, you would be pretty bored right now, right? So there you go. What's up, Garion? Yeah. All right. I'll end there. Maybe I'll revisit this video sometime down the line. But let's get to this here. Okay. So, given what I showed you today, you know, I've kind of wonder what's going to happen to a lot of the Zoomers and millennials now, because the boomers learned this lesson. 60-40. What is 60-40? The 60-40 rule is stocks to bonds. So 60% stocks, 40% bonds. If there's a problem, then you do 60% bonds and 40% stocks. That's usually how it is. That did not work in 2022. Right after that little chit-chat between Tom Lee and those other two guys. And notice those other two guys were wearing like caps and t-shirts and hoodies. You know, a lot of these financial shows, they try to hip it up to make it more appealing to Zoomers and whatever. But those two guys, you know, they would normally just wear polos and shirts or at least like a blazer. But how it is nowadays with marketing. So GMO argues the classic 60-40. So I guess who the hell is GMO? I mean, this is not genetically modified. What the heck is GMO? Who is GMO? Okay, whatever. I'm pretty sure it's not has anything to do with the GMO most people know about. Okay, argues the classic 60-40 portfolio works over very long periods, but can disappoint badly when starting valuations are stretched. Since the 1900s, it returned about 4.7% real. I guess that's real returns. So inflation-adjusted returns, is that what it means? Yet it also went through 6-week stretches averaging 11 years, which frames today's case for a more valuation-sensitive approach. Okay, lost decades are more common than you think. What is this? So I guess that's real yield. Okay. Most started with high valuations on stocks or bonds. Okay, so growth of $1 in real terms of a 60-40. So, okay, so this is inflation-adjusted performance of a 60-40 portfolio. Okay, log scale. All right. Okay. So we can see like there are these times when this 60-40 you got no money or you lost money in real terms. Okay. So after inflation adjustment, real terms here. All right. So, valuation sensitive investing has delivered attractive long-term results. Okay. I mean, I've heard these things before. I know people have always said like, "Oh, 60/40 is going to die. 60/40 is going to die." You know, I think this time around it might be really dead. I don't know. People have beaten this dead horse for a long time. They keep saying like 60/40 investment style, it's dead. It's over. It's going to be over. And we're entering a time where it might really be over. This might be it. This might be the time when we are. So that's why I'm teaching you these trading things, because you might only make money if you're an active investor or doing something different, because doing this passive 60/40 stuff, which a lot of your 401ks are set to this type of methodology. Okay. And it's like, unless you're retiring pretty soon, you might be screwed up if you just stick with whatever they set. So valuation sensitive investing has delivered attractive long-term results. So take a picture of this. So I guess this is what it is. So key takeaways. Since 1900s, a 60/40 portfolio returned about 6.7% real, but it also had 6-week periods that averaged 11 years. Damn, 11 years. From October 2007 to February 2009, benchmark fell 19.3% versus 35.7% drop for a 60/40 portfolio. So I guess this is just like, yeah, they're advertising something here with their report. So they want to give you a full report. Now, I wonder if this is going to be longer than just 10, 11 years, right? It could be like this. Because these 19 years here during the Bush era, I think we are, in a way, revisiting the Bush eras, from the Iraq invasion all the way through to the early points, right? So that was 10 years here, and we got this 19 here, and it's just like, man, this could be kind of like Bush plus, and it would replicate this. So this 19 years here is like, what is this? Freaking like the 1900s. So I don't know what happened in like during this portion here. World War I started happening here, I guess. So sometime between that and World War I don't know. Why is it 19 years? But I think we are going to have something like Bush 2, plus something that whatever happened at the turn of the century here, right? I think when was the Federal Reserve even made? Probably sometime during this period. And then we got off the gold standard in 33. I don't know. Something happened there. But it's going to be something like that, I think. And if it is, then this 60/40 stuff, yeah, is not going to work. So that's something to put in the back of your mind. All right, guys. So anyhow, all right. I think we got almost 2 hours. Okay. So I'm going to put up this tweet here. Last year's price drop of negative 18.9%. So this was during the COVID. I mean, not the COVID. The tariff. All right. The whole tariff tantrum. All right. Of 2025 was way bigger than this sell-off's 9.1% drop. Okay. But this year's valuation pullback, 18.4%, is almost the same as what we've seen last year. So I've been talking about like the forward PE ratio, forward price to earnings ratio, right? So even though the price of the S&P 500 did not drop as much, the forward PE ratio did. So I'm guessing that's because of all the software companies that got murdered, and maybe even the home construction, home builders, those got murdered too. Maybe even transportation stocks, right? Like the airlines. Oil goes up, airlines go down. So a lot of the airlines, maybe some of the cruise companies, Carnival Cruise, I think Royal Caribbean did okay. They held up a little bit better. But overall, higher energy costs, travel stocks go down, right? So a lot of those types of stocks got murdered. And so you kind of didn't see that in the price, though, because what? Semiconductors still stayed up. What else stayed up? I don't know. Oil, right? Oil plus semiconductors. I think those two were the only sectors that really went kind of sideways up. Semiconductors kind of just sideways, kind of up. depending on certain stocks. And then you had the associated electronics equipment, sectors. Okay. All right. Or our pyramid in America is a Maslow a pyramid of oil, where individuality, it's food and water. Yeah, could be. I don't know. Yeah, I think we have first world problems right now. It's like people are worried about Coachella ticket prices. It's just like boggles my mind. Like people worry about Coachella ticket prices. Are you serious? You serious? What the fuck? No, come on. You guys are crazy, man. Crazy. Okay. All right. Let's see. What else? I think I covered most of the things I need to cover. Okay, maybe this is interesting. Let's see. This is interesting here. All right. VR. Okay. All right. This might be interesting to you guys. You guys should take a screenshot of this. Okay. Take a screenshot of this. Figure 1, oil and gas infrastructure impact. Pipelines, terminals, oil deposit, ports, and fields. So let me do this for you. Take a screenshot. Take a screenshot of this, so you'll know what the status is for every port, pipeline, and terminal. Okay. Thank you, JP Morgan, for providing this information. All right. And then here's the oil, gas, infrastructure impact, gas plants, and refineries. Take a screenshot of this, so you know what's screwed up out there in the Gulf after all these bombardments and drone attacks and whatever. So might be useful for later. So take a screenshot of that. Okay. But anyhow, we are going to figure out what we're going to do here with Elliott wave and all that. So let me cover a little bit Elliott wave. And that I'll end it with that. I'll probably continue this discussion with the GAN and all that stuff sometime down the line. Here, you can go to the Wikipedia. They got the Elliott wave thing here. Elliott wave principle, or Elliott wave theory, is a form of technical analysis that helps financial traders analyze market cycles and forecast market trends by identifying extremes in investor psychology and price levels, such as highs and lows, by looking for patterns in prices. Ralph Nelson Elliott, 1871 to 1948, an American accountant, developed a model for the underlying social principles of financial markets by studying their price movements, and developed a set of analytical tools in the 1930s. He proposed that market prices unfold in specific patterns, which practitioners today call Elliott waves. Elliott published his theory of market behavior in the book The Wave Principle in 1938. Okay. So there are two phases. One is called the motive impulsive phase, where prices move in the direction of the main trend, and a corrective phase where prices move against the trend. So you would think of this as counter trend. Okay. So trend versus counter trend. So you have 5 waves in the impulse and an ABC going the other way in the counter trend, right? So 1, 2, 3, 4, 5 and ABC. So that's what I was talking about when I did the DeMark stuff. So you can go there yourself and doing this. So that's why when we do the DeMark stuff, it follows these rules, okay? Because the problem I had with Elliott wave is it's subjective. That's really the problem. That's why I didn't like it. I was like, this is subjective. Everybody is randomly drawing where they think the 1, 2, 3, 4, 5 and ABC are. What are the rules? Who is making the rules that say that this is the way you should look at it? That was my problem. But now that I paid money for this DeMark stuff, okay, I pay $1,000 a year for this garbage. Let's see. And I've been trying to figure this out for couple years now, since I got it for Black Friday, and I think I can understand it a little bit better. So that's why now I have all this craziness here. Let me get rid of this. Let's look at the waves, right? So this was Monday. This was the Monday bottom here. So this was the final C. Okay, now we got 1, 2, 3, 4, 5. So this is semiconductors. You remember when I was showing the chart, if I was just using my eyeballs, I would subjectively do 1 and 2. And I would just be like 3, some kind of 3 going all the way up, right? So I would be like ABC. With the DeMark stuff, you see now they go like 1, 2, 3, 4, 5. And it's just like, how the hell did they pick this as 3 and 4? I don't know. It's some kind of rule that they made. But the thing is, now it takes away the subjectivity of it, right? Anybody could go like 1, 2 and ignore this stuff and be like, that's 3. There's going to be a 4, and there's going to be a bigger 5 later. But because now there's rules set to it, I can just trust that DeMark here spent all his time and efforts to make this thing have a objective way of reading it. So that's why we're going to use this Elliott wave stuff now, because it's now objective because it follows a rule. So this thing will always follow a kind of rule, okay? So that's number 1. And then later we're going to do the Gant stuff, right? And we'll be like, well, I'm not going to use Gant probably. We have the cycles that we get, right, from the foundation of the study of cycles. So that will be good enough. All right, I can follow those things, and we can just model whatever we need from that directly instead of using funny things and don't know what the heck these pyramids mean. I have no clue, but people actually believe it, right? They actually go through all these pyramids and then they go like, okay, I see 96, 218. And then I go like 1, 2, 3, 4, 5, 6, 7, because there's 7 years. All right, because that's how the Hebrews looked at it. It was like 7 years of good times, 7 years of bad times, and we have Jubilee years or whatever. I'm gonna have to read the Bible and figure out. That's like, oh, bro, come on. I might as well just do gematria at that point. But it's based on something. It's definitely based on something, right? People did back then look at the stars and try to match what they saw on the ground with what was seen in the heavens. Okay, that was true. That's where the horoscopes come in. And but yeah, there is something to it, but it's not what they think, right? Pyramids probably were important,